Hey everybody, it's Anthony and Tucker with Land Title. We came to bring you your economic update. We like to do this about once a quarter just to really kind of dive into national stuff.
Yeah, and this way we can help you understand really what's going on out there so you can talk to your clients. And so when you hear something that they're saying or hear some of the national media and it's a little incomplete, you'll have a much better understanding. And so with that, let's go ahead and dive in.
We have breaking news, and really what's happening here is Showing Time puts out this stat where we're showing traffic over the course of the state, right? And with all of the hubbub in the marketplace, everyone keeps going, what's this going to do to the real estate market? How is this affecting things? Well, it is very clear as of right now that showing traffic has taken a non-seasonal dip because of the basically inconsistencies in the marketplace. When people don't know what to expect, they just don't make decisions, and so they don't go look at houses.
Mm-hmm. And this right here is really concerning because we are actually starting off and doing really well this year for given compared to last year's what this is really looking at. Compared to last year, we were coming off really strong. Showing activity was up, and then you can see right when those policy announcements came out, when the market started going haywire,
Right.
showing time dropped about 20% or so. And that's a really unusual thing for this time of year. Whereas you can see historically, I mean, it's super consistent historically over the last 3-4 years of just seeing where the market is and how it reacts. And then we have this year, we have this really out of the norm drop. It's something to be aware of, especially on your listings. It's just, you can share this with your client if you need to, if you're saying, hey, this is why we're not getting showings the last 2 weeks. That's why we had bunch at the beginning and nothing now.
Yep.
Use this data to help support. Now, it's not saying showings completely stopped. It's just a very
big slowdown.
It's a big slowdown as a percentage. I mean, it's like a 20% change.
Yeah. Okay, so we normally start with the national economy, so we'll get right into that for you. This is the federal total amount of debt versus the gross domestic product, the size of the economy. So our economy is roughly $30 trillion at this point. The national debt is $36 trillion. We're approaching that 120% mark, which really is concerning.
Well, we passed it.
We did pass it, yes.
We just passed that about a month ago.
Yep. We spend a lot of money in this country, and we don't make as much as we spend. So that is why there are plenty of conversations about cutting federal spending, right? Because we are just spending too much money. Now, you can see historically what this has looked like over time, but here we are in a spot where you really should be sort of concerned. So yeah. This is why we're just starting here. Let's get into the next one.
Now, the next piece here is we're talking about the Fed rate, right? That's our short-term interest rates versus the 10-year Treasury bill. 10-year Treasury bill is the best indicator for our long-term mortgage rates, right? So that's why we follow it so much. And what we can see really here is where we're at with the 10-year Treasury is it's gone up quite a bit since where we at the start of the pandemic when they artificially lowered rates. Now you can see where we're at, and you see we've come off the peak a little bit, but we're still having a lot of daily volatility, but it's staying fairly consistent on the 10-year Treasury note, which means our mortgages have been fairly consistent, right? Sitting around that 6.5 mark, give or take, depending on the week, but really kind of staying consistent between 6 and 7 so far this year. That's the interesting piece about interest rates is they normally don't change quickly. It takes a long period of time for them to really change. And looking at this is why we're taking a look down here at the 10-year Treasury. Historically, we can see how it's really been trending down really since the 80s and during that really high period of inflation during the late 80s, how it's been trending down, which also had lower interest rates following it as well. So that's why when you're looking in the markets and you hear bond market yields are going up, that means mortgage rates are going up, right? Those are one-to-one relationship. When they go up together. So that's why we care about it.
All right, so comparing that to the 2-year being short-term debt, think car loans, think, short-term savings bonds, things that really affect short-term supply of money, right? Mm-hmm. Not long-term supply of money, which is just the 10-year. When these get inverted, it generally leads to recession. So you can see prior to each one of the last recessions, those big gray bars, you could see that the yield curve was majorly inverted, or sometimes just slightly inverted. And here we are in a position where maybe we're not in the same sort of environment, right? We've seen these huge decreases or changes where short-term money is actually cheaper than long-term money. And it creates this issue where, it's usually just an indicator, right? So we could be heading towards recession. That's what everybody has been looking at. But we have a lot of other indicators doing other things. And the Fed's making decisions in a very different way than they have in years past. But this, for years, was the preliminary indicator for recession.
And that's why for the last 2 years, everyone was saying, oh my gosh, recession's imminent.
Yeah.
Because historically that's what it showed. But the economic factors going into what cause and effects are has been changing because the way the Fed's handling this right now, this current cycle, is very different. In the past, they were inflation first, employment second. Now they've been weighing on employment more than inflation. So they're actually working them in tandem, which is it's actually a big change from historical Fed policy. And that's really what's kept us out of the recession and quote that soft landing that we actually kind of did hit relative to not going into a massive recession.
All right, so look at this. This is personal savings rates. The reason we look at this is we look at consumer spending and all these other things, right, to kind of go into this. But when people save less money, they more likely are accruing more debt. A lot of times what happens is, people get used to a certain lifestyle and they don't want to give it up. Like during the pandemic, for instance, we gave out checks, we gave all the stimulus, and then people didn't really slow their spending. Instead, they just didn't save anything.
Mm-hmm.
And so we're seeing this where we're at one of our all-time lows. The only time it's been lower than this, according to our historical data here, was back pre-08.
Yeah,
right?
And that was right before, that was in a different, that was a pretty nutty market, if we all remember that. That led to the housing bust of bad financing. So different reasons. But
this is M2 is the supply money.
Yeah, so M2 is really just kind of accounting for all of the monetary instruments in our current supply of money. And the reason we have this on here is looking at this top graph, you can see how we've really accelerated in through COVID and out of COVID with really increasing a ton of monetary supply. And that was through the Federal Reserve doing what's called quantitative easing. That's where they're buying bonds and just adding extra money supply to the market. And then you can see where we kind of hit that peak around, May 2022, and then we started dipping down. That's when they started doing the quantitative tightening.
Yep.
And that also pushed our mortgage rates up. So M2 money supply, while in macroeconomics and even microeconomics, mostly macro though, it will affect the short term significantly. It doesn't affect the long term as much, but in the short term, which is several years, your M2 supply, your money supply, is really important because that's where we just see there's extra money in the economy or there's not. And when there's extra money in the economy, it's normally more frothy and it's a higher speed and the economy's growing, whereas when you're pulling money out, it's shrinking. And that means there's less opportunity and less returns.
Okay, so the real question, I think, is can the federal deficit be cut? And we don't necessarily have an answer for you. I just wanted to present some data to show you what we're experiencing. Over the course of history, you can see the bottom graph. We've always spent just a little bit more than we made. And it wasn't really an issue because the economy grew so fast in the US that it outpaced the debt consumption, right? So here we are, you can see back in basically, really late 90s, I think, Clinton administration. It was the last time we really had a budget surplus, right? Mm-hmm. Ever since then, we've been fighting different types of recessions, right? We had the dot-com boom. We finally recover a little bit. Then we have the 08 issues. And then we spend a decade-long recovering, and we just spent too much money, right? And so then we have the pandemic where we spent basically $1 trillion a month more than we should have been spending, which is why there is this huge drop. Now, it did do a lot of things like keep us out of just complete turmoil.
Or a complete depression. We're not getting into that piece. We're just showing what's happening.
By the month, each one of these months, you can see that, normally we'd be spending $100 billion, $200 billion, which is not a number to take lightly, more than we make. But the economy did grow enough to outpace that. Here we are in a position where we're spending $200, $300, $400 billion a month more than we're making. And that's creating some of this issue. So that's why you're really seeing deficits, why you're seeing so much tightening in the federal government side of things.
Yeah, and that's right. You either have to increase revenues or cut expenditures.
And ideally, you do both, but it's not always that easy, right?
Yeah, good luck getting anything done in Congress. All right, so what we're looking at here, once again, you'll see the blue line is for the nation for unemployment rate. And really, this pattern's going to follow through on all the rest of the slides. Our green dots are Colorado, and then our orange kind of dashes is Boulder County. So what we're looking at here is our unemployment rate has historically always been in Boulder County and Colorado lower than our national average. Other than a few spikes here and there during the 80s, a couple times in the early dot-com boom just because we were so tech heavy in Boulder, our unemployment hit a little bit higher than national average. Right now, we've been trending and our trends are going higher than the national average, which is a little concerning because our jobs here in Boulder County are not the average job across the country. They're much higher paying jobs. And the same for Colorado. We have higher paying jobs. And so when we have a higher unemployment rate, it's disproportionately affecting some areas like Boulder because our average per capita income is so much higher than the national average, let alone Colorado.
Okay, so let's talk about per capita wages, right? Tucker talked about the height of the income. Finally, we have new data to look at in 2023. That's the last data for Colorado and Boulder to be recorded, which just happened this quarter, right? Mm-hmm. Lags quite a bit. You can see we have $100,000 per household income. Now, the interesting part about this personal income per capita is, we're way above the national average, right? It's not even 70,000 during that period in time. We substantially are, nearly 50% more income coming into a household, but housing prices are way exceeding that, right? You assume at that period in time, average households were, 350, 400, maybe in some markets, but you have $1 million homes here in Boulder. So it makes it really disproportionate. So the affordability is far worse here than it is in most of the rest of the marketplaces.
All right. So we're just going to do a quick little thing of just nationwide what's going on. Month over month, we had a nice jump from February. That's from January to February. This is from NAR, so it's a little bit delayed for the national data. But this is just showing, January from February had a nice increase, but year over year in February, we were actually down in sales across the country slightly. But even with a decrease in sales, our median sales price still went up 3.8%. So that's a nice showing of stability for the housing pricing at the housing market across the country. And remember, this is the data that policy is made off of. We make federal decisions on federal data, on nationwide data. Yep. So our market in Colorado will have a different feel than the nation. So the policies that come out may not be exactly applicable to us here in Boulder, or let alone Colorado.
Okay, kind of as we dive into this is the housing price index. So the orange line, the index of affordability, right? That's the one that if you look at that long-term trend at the top, you can see has just gotten kind of out of control, right? We really have never experienced anything like this spread. Now, the median household price, that's the blue line. If you look at the bottom, it's much easier to read this, but you can see all this fiscal policy has really actually slowed housing growth, actually declined housing prices median-wise across the nation. The average is very stable. It obviously is a little more seasonal, but you can see that it stabilized as well. So that is helping. That was part of the point, right? Is housing was getting out of control. It was a runaway train. We pulled it back quite a bit, and here we are feeling some of those effects, which we finally can see. But affordability is not right because interest rates are high. Yeah. So as interest rates come down, if you can keep housing prices lower, then affordability is a really good sign that we could get back to an affordable market. The question is, can they do it, right?
That's right. And that's where we're going to be looking at this fixed residential mortgage. We're looking at a 30-year. And up top, we have our little bit longer term, or excuse me, on the bottom, we have our longer term. On the top, we have our shorter term. And we can really see how once the rates went up, that was when the market slowed down. So there is no beating around the bush. Lower interest rates equal faster market, more buyers, because more people can afford and get into a higher price point than they would have otherwise. That's just the facts. That's what the data shows. That's what we all know. So that's why we focus so much on interest rates. But what we can also see here is we're kind of hitting that 6 to 7% interest rate. Don't be surprised if we're in this for several more years, and hopefully we'll start trending one direction that's lower, hopefully. But you'll notice that sometimes. Yeah, but you'll notice here that it's normally rates take a while to really move. It can take a long period of time for them really to make substantial changes.
And that's market shifts are 5 to 10 years at a time. You can really see it in the market. Now, are they a little, hit or miss, right? Could you refinance if you buy now? Yeah, absolutely, because interest rates will dip and then they'll rise and they'll dip, and they may slowly trend in the right direction. Think like between the late 80s and the early 90s, you saw that type of a market. We're not going to be in a stable interest rate environment because we really are trying to push them lower. Yeah. But we are not going to be in an easing market that fast, right? It takes years.
Yeah. And then the other piece I just want to touch on real quick is just remember when you're talking with folks, their age matters in the sense of what we understand for rates. I've never known anything but cheap money. Neither has Anthony. And really going almost all the way back to early 2000s, we've had a pretty low interest rate historically. And so everybody, that 45, 50 demographic and under, the majority of their life, they've only experienced cheap money. So that's where the folks who are a little bit more aged experience will have that better historical knowledge of, we've been lucky the last 25 years. That isn't always the case. And that's where this historical information below is so helpful, is rates have been higher in the past, and it takes a while for them to really change.
Okay, so supply of listings on the marketplace. You can see the trend, right? Year over year, we've had an increase in active units on the marketplace as a nation, as a state, even locally. But the seasonal trends are very different, right? We seem to see more listings on the market in the summer times here in Colorado with deeper valleys, right? Because we have snow, we have seasons, we have all these things that a lot of the nation doesn't always experience. But we're all kind of trending in the same direction. Inventory is rising. We just have been rising faster than most of the market. Now, if you look at new listings coming to market, this is one where there is a true listing season. You see March through October be that time where even nationwide, it's just the easiest time to sell. So sellers have a different behavior than a lot of buyers in many ways, but we're just suppressed, right? Like you really have seen, this actually is the first year where we've seen a dramatic increase in sellers coming to market, maybe more so than buyers in many ways.
Yeah, we definitely have seen more sellers coming to market than buyers. And that first slide we showed the buyer demand through showing time kind of falling off.
It did.
But let's stay back on this. So right here, this is our month supply of new homes in the United States, right? This is for new construction. And you can see, right, we have a housing shortage. Everyone here, but we talk about it. We know we do not have enough units in the nation. Across the nation, we do not have enough. But the issue is these builders are building them, and they got 9 months supply of inventory sitting out there of their new product. So what does that mean? That means if they didn't build another home right now, it would take 9 months. It'd be the end of the year by the time they sold off all their existing inventory. And that's because of the cost to build new builds is more expensive than the existing product. Yep. And until that gets cheaper through policy or some other type of change, or
it could be a lot of things to change it.
But some needs to change there if we want to actually increase our housing stock, because we have the shortage, and right now they're just not moving. So we can see if we have 9 months, how can I tell a builder to go build another 3,000 units across the state when their existing stuff isn't being sold? And so that's what's slowing down the new development, is we just don't have enough demand for it because of the price.
It's true. You look at demand from the public. This is demand on resale homes. You can see that, housing inventory was pretty high, but we've seen buyers controlling that, basically the entire market, right? As buyers control the market, this is the most important stat to pay attention to, is when are they buying? Well, buyers tend to peak earlier in the year. They don't really care when it's convenient for you to sell it. They care when it's convenient for them to buy houses and move. And so they don't have nearly as much seasonality. So you're going to see dramatic seasonality in the sellers, but in the buyers, they're pretty stable through the bulk of the middle of the year.
Yeah.
Now, we are just in a very muted level of sales compared to where we were in the pandemic, and it is very stable right now.
Yeah.
Now, it just means that until something changes, don't expect buyer demand to change, right? And if something does change, including tariff talks or whatever, they will change positively or negatively depending on how that's going to affect their view.
And I just want to point out, we had that nice little rate drop in, what was that, like September or so last year. And you can see in the graph how instead of it being the traditional curve of it going up and down, it went up and then flattened and then dropped off. That just shows how powerful and how much demand is on the sidelines for rates to drop.
So we're talking less than a half a point there, right?
It was a half a point, and you saw what it did to the market. So if we do get lucky and we get some good relief in rates, be ready with your buyers, your listings. Boom, throw them on the market. Those things that were maybe withdrawn, just be really aware of, when you see rates truly drop, from your mortgage friends when they're telling you, follow it and jump on it and you capitalize on it, because that is going to be a huge window of opportunity for you as an agent.
It is. Now, if we look at median list price per square foot, this is one where we kind of have this conversation about Boulder County being so drastically different than the nation or the state. You can really see here just how much more expensive it is and how the seasonality changes pretty dramatically during that time frame. We have bigger peaks and valleys depending on when it makes more sense to sell luxury real estate or when we sell anything else. So basically, you can see median list per square foot has stabilized at a nationwide level. Colorado has slowly increased, but it's seasonal. And then, of course, Boulder County bouncing around as it
Mhm.
does, depending on the luxury sort of sales in the marketplace. Median days on market, though, Tucker. What is
Yeah.
this happening here?
So let's talk median days on market. And we're really comparing the country and the entire country in blue, right? We have Colorado in the green, and then once again Boulder is in the orange. We can really see our days on market historically have been lower than the nation, but with our much more rapid increase in prices and just our overall numbers, not just the percentages, but just the numbers of it being a million plus for a single family in Boulder.
Yep.
That just shows how affordability is affecting it. And we can really see the days on market, we're getting higher than the national average. So when you have folks who may have a second house here and they live somewhere else and going, why is it taking you so long? You're getting the pressure. Show this. Hey, right now in Colorado and in Boulder, it's taken longer. We have a higher median days on market for the last several years, and that trend's probably going to continue. And right now, we're dropping in that median, right? We're going to follow that median. It's going to start dropping for the next about month or two, and then we'll start picking up come June once we really hit the peak of our supply and the buyers, kind of slow down a little bit gearing into the summer holidays.
Okay, so this is more of a year-over-year change slide on that median days on market. I think this can articulate it really well too. You can see that 32% change in the median days on market in Colorado is what's really pushing and showing that we just have so much more inventory than maybe the rest of the nation is used to. So I think that's important to use and know. You can see that it's happened a few times in history where we are in an extremely different situation. Pandemic times, it was the opposite, right? It was extremely less inventory. Here we are, big inventory surges, creating longer times on market. So that's basically all we've got for you today. We really appreciate you joining us for our national segment. We try to do this every quarter. If you haven't caught it before, don't forget to like and subscribe to the YouTube channel if you just want way more content from us.
Thank you again. We hope you have a wonderful time out there and wish you well and enjoy the warm weather. Take care, everybody.
Bye.